across all of commercial real estate, I think the best opportunity set is on the credit side. The credit trade, to me, hands down, is the most compelling trade today. And if you're doing direct lending, where you're financing groups to go out and acquire and develop assets or even recapitalize existing assets, in a lot of cases, we're ultimately driving from a standpoint of the investments we're making, we're getting outcomes that are very similar to what we would be getting if we were investing on the equity side.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Greg Friedman, thank you for taking the time to come on the show today. I certainly appreciate having you come on.
Yeah, thank you, Sam. I appreciate the opportunity to be on the show with you today.
Absolutely, Greg. As our listeners know, normally I give the guest bio there in the beginning, telling all about the guest and where they come from. But instead, we're just going to skip straight to the same question I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Definitely. I graduated from University of Texas at Austin back in 1999. I spent, about 8 or 9 years in banking before I started Peachtree, going back, to 2007. And, Peachtree, when I originally started, it was a small family office that we were focused on going out and acquiring and developing hotel assets. And like all businesses, we've transitioned through the years, and we've transitioned into a vertically integrated private equity firm that invests across, all commercial real estate property type. So we invest, still very heavily across the hotel space, but we also have investments across all commercial property types, as well as we have investments outside of real estate as well. And then, as I mentioned, we're vertically integrated. So we own an operation, development, lending, asset management company, so forth.
That is fantastic. Did you grow up in a family of entrepreneurs?
I did. So my grandfather was a huge entrepreneur. He was a doctor by trade, and he also owned a bunch of real estate, like any good doctor that lived in a small town in Alabama, because I grew up right outside Tuscaloosa. He was, he was very focused on not only being a doctor, he was an eye doctor. He was also focused on doing everything from owning commercial real estate, to owning a home building business, to owning movie theaters. So he was, very entrepreneurial. So he was a huge influence on my life. And he, owned hotel properties. And that was, that's how I sort of got into the business, because he owned a business that owned hotels, but also owned a hotel lending business. So I personally grew up around the business before, professionally getting into the hospitality business on the lending side when I graduated college.
Got it. And so was that, I guess, and maybe that's the answer to the question. That's kind of what gave you the bug early on that said, hey, this is kind of the direction we're going to take. But what did you decide to do differently, maybe, when you launched Peachtree, that your family wasn't already involved in?
Yeah. So, at this point in time, when I launched Peachtree, my family was pretty much out of the hotel business outside of, some limited investments. So it was, my grandfather, unfortunately, he was, at this point in time, he passed away shortly after I started Peachtree, but didn't have a lot of, he had sold off most of his investments. And same for my mom, who was a big influence as well. But really went in and, initially thought I was going to, just focus, because I knew the hotel business from a professional perspective. I was out there financing, capitalizing hotel projects, and have financed and capitalized over 300 hotel projects across the U.S. when I was on the banking side. So I wasn't necessarily looking to duplicate what the family business had done. I was trying to really create my own legacy. And, with myself, and I had a partner that still is involved in the business today. The two of us both wanted to create our own legacies to go out and, acquire and develop hotel properties. And we had, our own capital that we were investing. So, personally was using my capital along with my partner. And then our family members were investing heavily. So my grandfather, my mom, and so forth were big investors initially when we went out and acquired developed assets when we set up the business.
Got it. You launched that in 2007. That seems like the prime time to get heavily into commercial real estate. How did you weather the next 3 or 4 years?
Yeah, so we're good at picking timing here. So we picked it in May of 2007 is when we formed Peachtree, and that was probably the absolute peak before the great financial crisis.
Right.
And so we went out and made about eight or nine investments across the lodging space in 2007 timeframe, where we bought some land parcels that we ended up developing into hotels shortly thereafter, or we bought actual hotel assets. And it was sort of interesting, just as I reflect on it, because, it was probably the best lesson, for us on the business side, because we quickly went from, being able to play offense, meaning we were able to make investments, to having to play, truly play defense, because we were going through one of the, worst economic situations of all time with the great financial crisis that really took hold by the mid part of 2008. And we successfully navigated through that environment. Not only did we end up producing, decent returns, all those investments we made, we actually made positive returns on every investment we made pre great financial crisis. But we were super active. We were, very good about not only playing defense, but being able to go out and play offense and buy a lot of distressed debt during the great financial crisis, where we bought over, 50 loans. We bought a lot of hotels that were in distress on the real estate side as well. And we bought, we developed a bunch of hotels from the ground up in the middle of the great financial crisis. So we had a lot of success making new investments, as well as playing defense and, being able to, really optimize and drive the returns across our, our existing investments at that point in time during the great financial crisis.
It sounds like you guys were, what's be brave when others are fearful. Like you guys were
Right.
brave when others were fearful in this time. What did you guys do differently that that allowed you guys to go out and buy distressed hotel assets and say, or distressed debt, whatever it was, and say, hey, we're able to do something better than the previous operator has done?
Sure. So I think, a couple of different things. I think it's just part, at this point in time, I think it's part of our DNA of our organization. And when you look at just the culture here, we're not afraid of chaos. We're not afraid of, operating in tough environments. And we've had a lot of success doing that, obviously, through the great financial crisis. And then even through the pandemic, we were one of the most, active buyers of distressed debt. We bought over, 180 loans in 2020 and 2021 in the middle of the pandemic. We bought a bunch of distressed hotel assets even during the pandemic, as well as, we made a lot of direct loans to groups that needed rescue capital, made over, 29 loans to different groups that needed rescue capital to make it through the pandemic. So I think it's one of those components where we're willing to be decisive when the market pulls back. You find a lot of groups become, very timid when there's a chaotic environment, when there's disruption in the marketplace. And we're very proactive in the sense that we, like what we did during the great financial crisis, we were very proactive in asset managing our current investments and really setting those investments up to be successful. And then simultaneously, we were able to, shift our mindset, because it's hard to play defense and offense at the same time. And you have to sort of, you have to bifurcate those two strategies. And that's something we did successfully during the GFC. And then as we grew our company, because we were much larger, before the pandemic started, and we're even larger today than before the pandemic. But, we were able to split our team, where we had a certain part of our team focus on playing defense and really optimizing the performance of our existing investments. And then we had another team focused on going out and making new investments and finding and sourcing opportunities. And in a lot of cases, what you find especially in the hotel industry, there's a lot of inefficiencies from one operator to another. And we internalized the operations side going back to 2008 and Peachtree. We did it in order to play defense during the great financial crisis, and having our own internal hotel operation platform has paid dividends for us, not only being able to identify opportunities, but truly being able to outperform, how other operators operate. And unfortunately, when there is disruption in the marketplace, like a pandemic or a great financial crisis, you can quickly see who's good at operating and who's been struggling, but, has had the benefit of the, economic conditions before that disruption.
What are some telltale things that you guys look for in an operation where you say, man, that would be a great buy because we can implement X and make this so much better?
Yeah, so a lot of it is looking at revenue management strategies. Like, you find that a lot of hotels don't really optimize their actual revenue management strategies, being able to maximize rates that they're charging and simultaneously driving the occupancy, so being able to drive those revenues into the asset. You find that other operators are really good at revenue managing, but when you get these revenues, they just overspend. And, you want to drive great guest experience, and we pride ourselves on being able to do that across our portfolio. But you want to be able to, simultaneously, because you're making you're making investments in these assets because you're a for-profit enterprise, usually. And for us, we're for-profit. So we want to make sure we're able to control expenses, and we keep a very tight budget on what we're spending on the operation side, but we're doing it at a level where we don't want to impact the guest experience. So being able to balance that out is usually where you can find those opportunity sets. And then, I would say from a more just high level value add strategy that we've been able to implement, when you look at the hundreds and hundreds of, investments we made on the equity side across hotels we've acquired, what you find is a lot of times hotels are undercapitalized from a capex perspective. So we'll buying an asset and go in and spend a lot of money to renovate that asset and actually bring it into a level where it can be competitive with the other hotels in its comp set, to be able to charge higher rates and be able to drive occupancy. In other cases, you find that we're able to not only spend money to drive performance from a standpoint of renovating the asset, but change the brand. And going from one brand to another brand, there's a lot of value that could be created by making those brand changes. And we've had a lot of success in doing that, taking something that's maybe unbranded and putting a Marriott or Hilton brand into it, so it has a strong reservation system to help drive that performance.
No, that's really, really excellent. I love the insight there. And I know probably of all commercial real estate asset classes, I know the least about hotels. So this is kind of a fun conversation for me to learn from you. So, well, Greg, let me ask you this, like, where is the opportunity that you guys think in hotels today? I mean, it's something where, the traveler preferences have changed. We've seen a lot of, I think, shift in the market. You mentioned here, even before we started hitting record, that you saw that there's chaos in commercial real estate. So I'm sure, having weathered 2007, been through that, built an enormous company up till now, you guys are constantly reassessing where opportunity lies. So give us kind of the insight on what you think and where you guys are positioning yourselves as it pertains to the hospitality space as a whole.
Yeah. So, and we love the hotel space, and we also, we still think there's a lot of opportunities within commercial real estate outside of hotels as well. But across all of commercial real estate in general, hands down, the best opportunity set today is not to go out and acquire assets. We think there's a better opportunity set actually on the development side across hotels today. Although I think there will be a better opportunity to buy hotels more opportunistically later this year. But we're finding, a better opportunity set if you are investing on the equity side, on the development side, versus actually acquiring assets. But going back to my original point, though, across all commercial real estate, I think the best opportunity set is on the credit side. The credit trade, to me, hands down, is the most compelling trade today. And if you're doing direct lending, where you're financing groups to go out and acquire and develop assets, or even recapitalize existing assets, in a lot of cases, we're ultimately driving from a standpoint of the investments we're making. We're getting outcomes that are very similar to what we would be getting if we were investing on the equity side. Yet we're in a position that you could argue that's protected, because we're in a lower leverage position, because we're financing 60 to 75% of the acquisition costs, development costs, the current value of the asset if it's a recap. So to me, that's the best opportunity set right now, is to invest through credit versus taking on the last dollar risk on the equity side. But if you are going to take on last dollar equity risk across hotels, I believe the development side to be super compelling, because there's a lot of markets. When you look at hotels in general, supply is down roughly about 30 to 40% from historic averages. So supply is growing at less than 1% a year. That's projected to be the case for the next 5 years or so. And that's just that's really the outcome of what happened during COVID, where supply pipelines were shut down because nobody wanted to build new hotels when no one was traveling. And then all of a sudden we transitioned, as travel started coming back, back in 2022, we started transitioning into this environment where the credit markets became dislocated. So it became more and more challenging to finance construction or new construction assets. And that's created that constraint of new supply. And simultaneously, there continues to be robust demand drivers. Like, demand continues to grow from where we were even last year across our industry. And we're still expecting over the next 5 years, demand's going to be growing at historic levels at 2% or higher per year. So demand's way outpacing supply. And there's a lot of markets that could support new hotels to be built in. That's one reason why we do favor development. The other, just sort of interesting component to hotels compared to other property types today, if you wanted to invest across, any property type, hotels trade at higher cap rates. And part of the reason, I'm probably a little bit, negative towards equity investments in general right now is I still think we're going through this whole repricing across all asset types, especially, commercial real estate, because interest rates are much higher today than where we've been over the last decade. We've averaged, like, use the 10-year treasury rate as the risk-free rate. The 10-year treasury rates, averaged around 2% over the last 12 years or so. And, you look at today, the 10-year treasury rate's around 4.3%. So the 10-year treasury is almost double where it's been over the last 10 or 12 years. And, I believe that the 10-year treasury is going to stay elevated. And if it does stay elevated, when you start applying risk premium spreads, which the 10-year treasury rate is, from my viewpoint, the risk-free rate, and if you apply the risk premium spreads on top of it for what commercial real estate typically is, which is on average about 275 basis points above that risk-free rate, you start to realize a lot of assets, a lot of these assets that are trading at a 5% cap rate or even a low 6% cap rate, you could argue you could see continue to see a cap rate expansion from where they're trading at right now. And that's the risk of making equity investments. I'm not sure if the market's fully reset, whereas hotels, are trading around 8% cap rate. So you have higher risk premium spreads. You have less repricing risk. And that's why hotels are, more compelling on the equity side than some of the other property types that you see out there.
I love that explanation. Thank you for taking the time to do that. On that credit side of things, what are people building now that what are people building right now that makes sense for you guys to be the lender on?
Yeah. So, I mean, on the development side, we're financing a lot of new hotels that are being built. So we're doing a fair amount of construction loans. We're doing a lot of acquisition loans, as you can imagine, outside of construction. We're actually doing some multifamily construction loans. You have a record amount of supply getting delivered in multifamily. So we are very selective on the markets that we are financing, but we are doing some multifamily construction loans, some stuff on the industrial side as well on construction lending. But by far, the majority of the type of loans we're making today are going out and providing acquisition financing or recapitalizing existing assets. And we are starting to ramp back up on buying loans. We bought 4 loans in the month of December alone. We're in the process of buying several loans as we speak today. And when we buy loans, this isn't, our credit strategy is not a loan to own strategy. Our strategy is to go in and buy loans or even make loans with the idea of helping the borrower be successful. That's what our focus is on. As we buy these loans, we typically buy them with the idea we're going to restructure the loans and hopefully allow the borrower to have runway to be successful and get us paid off, for the next couple of years as the market normalizes back out.
Right. No, and that's a lot of moving pieces there and a lot of different strategies I think that you guys are employing all at once. So it's a lot of fun to hear you just talk. I know you probably stay at the 30,000 foot level with a lot of people making a lot of these things happen. I think that's really, really cool. But I guess maybe even a more direct question is on the construction loans that you guys are doing. I guess I'm trying to understand the type of traveler today that the hospitality space not the type of traveler that we're building for today. What is that?
Yeah. So typically we're focused, on just to sort of put to scale what we're looking at. It's typically select service, limited service, compact full service extended stay hotels with 100 to 250 rooms.
Right.
So typically the type of guests we're going after are the, corporate travelers. In some cases it's leisure demand, because each of these submarkets have different, demand drivers that are driving who's actually utilizing these hotels. But I would say the majority of the demand is coming from corporate and group demand, as well as, there's a decent amount of leisure demand, which usually makes up about 20 to 30% of the hotels that, we invest into have a leisure component to it as well.
Sure. No, that answers the question. That was, that's super insightful, because that's kind of the answer I was expecting. Because I think we've just seen kind of the demand profile change, I think, slightly over the years, and that was the answer I probably expected right now, was that more select service corporate traveler sort of clientele at those hotels. So that's really, really cool. Greg, we've talked about a lot of different things today. I mean, you guys have grown an enormous company here over the last, what is that, 17 years?
17 years.
Yeah, man. Congrats.
Yeah.
That's a lot of fun. You've done a lot of things. You've shared with us today your thoughts on the market as it is today, where you guys see opportunity. You've shared with us how you guys have built your firm, the types of things that you guys are investing in, the opportunities, and how you guys have diversified yourself over the last 10 years or so, and what you've been investing in, the types of loans you're buying, acquisitions, development. And a very insightful show. I appreciate you taking the time to come on today. If our listeners want to get in touch with your firm, what is the best way to do that?
Yeah, just visit our website, peachtreegroup.com, and we're happy to, connect with anybody that connect with us.
Fantastic. Thank you again, Greg. Appreciate your time today.
All right. Thank you. Talk soon.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.